So the S&P 500 closed up today, a solid 0.67% at 68.8668.
Right, on the back of that Fed rate cut everyone was waiting for.
Exactly. But that headline gain, it completely misses the real story of the session.
It really does.
The critical signal, the massive vote of confidence, was the dramatic outperformance of the small caps. The Russell 2000 surged 1.32%.
Vaulting to a brand new record high. 25.59.61.
A new record.
Yeah, you're right to focus there. It was one of those days where the market got exactly what it expected, that third rate cut. But the reaction was, well, it was anything but expected.
Right.
We saw this deep complexity, inside the FOMC, this aggressive risk rotation in equities and some really baffling divergences across other assets.
So that's our mission today then, to really unpack the fallout from the Fed's action and figure out what these contradictions are telling us.
Let's do it.
Okay, let's start with the main event. The Fed delivered the expected 25 basis point cut.
Yep.
So the federal funds rate is now 3.5 to 3.75%. That was totally priced in. So why did the way they delivered it cause this sharp repricing?
The devil, as always, was in the details. Specifically, the fragmentation within the committee.
The internal tension.
Exactly. What's so fascinating here is that we saw the first triple dissent since September of 2019.
Wow, that long ago.
Think about that time frame.
Yeah.
That level of disagreement at the top. It signals genuine policy uncertainty. Chair Powell wasn't just managing the economy today. He was managing, like, a committee civil war.
That's a great way to put it. And it wasn't just disagreement. It was coming from both sides,
Okay.
like both the doves and the hawks.
Precisely. On one side, you had Governor Miron, who wanted a much deeper cut. He voted for 50 basis points.
Okay, so that's definitively dovish. He sees the risks as immediate.
Acute and immediate. He's worried about the labor market, about a potential recession. And then on the other side...
You had the hawks who wanted to hit the brakes.
You got it. Presidents Goolsbee and Schmid, they preferred no change at all. They're still worried that inflation isn't fully dead yet.
So Powell had to navigate that gap.
And he did. He delivered the 25 points, but he called the decision a close call.
Which is very unusual language for them.
Highly unusual. But he tilted dovish by specifically calling out the downside risks in the labor market.
And that's what got the equity bulls excited. But it was only half the message, wasn't it? What did they say about 2026?
That's the critical nuance. While they gave the market the cut today, their forward guidance projects only one. Just one additional cut next year.
And that's unchanged from September.
Unchanged. It shows that they are really committed to being cautious. They threw a bone to the market today, for sure.
But kept a very tight leash on the future.
That's a perfect way to put it, and that's why we saw such limited action in long-term treasuries. But for equities, that immediate cut was the green light they wanted.
Which brings us right back to that small cap breakout. The Russell jumping 1.32%, outperforming the S&P by 0.65%. That feels definitive.
And it wasn't just a sugar rush. You have to look at the technical health here. The index is now trading a full 4.05% above its 50-day moving average.
Wow.
That is a technically robust breakout. It suggests real money, institutional money, is being put to work there. Small cap leadership like this means confidence in the domestic cycle is on the up.
We saw that risk-on attitude across the other indices, too. The Dow actually led the majors.
Surged 1.05%, up nearly 500 points.
But the Nasdaq lagged a bit, gained just 0.33%.
Yeah, a bit of consolidation there. A lot of big tech earnings were coming after the bell, so people were likely just waiting on those.
And the sector leadership really confirms that story.
Yeah.
It was a classic cyclical rotation.
Classic. Materials led the whole pack, up 1.96%. Industrials were right behind at 1.83, and consumer discretionary was strong, up 1.47.
So the building blocks of the economy.
Exactly. When those sectors are leading, the market is making a clear statement about its growth outlook.
Which means defensive sectors should lag. And that's exactly what we saw with utilities.
Absolutely. The sole decliner on the day, down just a tiny 0.05%.
And that's textbook behavior. Utilities act as a bond proxy, right?
They do. So, for anyone who might not know that term, a bond proxy is basically a stock or a sector, like utilities, that pays a high, stable dividend.
So it mimics the income from a bond.
Right. And when the Fed cuts rates and risk appetite goes up, those safe, yield-focused names just become less attractive. People would rather chase actual growth in small caps and cyclicals.
Okay, so let's talk about the leverage in this move. Volatility?
Yeah.
The VIX just collapsed today.
It really did. Plunged 6.85% to 15.77.
So hedging demand just evaporated.
It did. The market got its friendly message and dropped its insurance. The VIX is now trading 14.72% below its 50-day moving average.
That sounds compressed.
Highly compressed. And while low vol is great for rallies, it creates a lot of asymmetric risk.
Meaning any negative surprise could cause an outsized move to the upside in volatility.
A disproportionate expansion, exactly. The market is priced for perfection right now, and that's a dangerous place to be.
You mentioned the bond market. The 10-year yield fell only 3 basis points to 4.16%. Why wasn't that move bigger?
It all comes back to that cautious forward guidance. Bond traders are looking past today's cut and focusing on the Fed's path for 2026, where they only see one more cut.
They're saying rates might stay higher for longer than the equity bulls are hoping.
That's the signal, but we did see some confidence in corporate credit.
Right. LQD, the investment-grade corporate bond ETF, outperformed treasuries.
It did. Up 0.46% versus TLT's 0.39. That shows confidence in corporate fundamentals. They're willing to lend to solid companies.
Okay, so cyclicals leading, confidence in fundamentals. Let's look at a stock that just embodied all of that today. GE Vernova.
An absolute monster of a day. They dominated the headlines, surging about 16% to a 52-week high.
And this wasn't just about a good quarter, was it?
Not at all. It was all forward-looking. They announced these ambitious 2028 financial targets. They're doubling the dividend, and they expanded their buyback program to $10 billion.
And the narrative here connects heavy industry with a future tech theme, right?
That's the magic. GE Vernova is in power equipment, and now they're seen as a huge beneficiary of AI-driven electricity demand. Its industrial growth meets the AI boom. That 16% move is the market betting on that long-term story.
And we should note the AI narrative is getting tested right after the bell with earnings from Oracle and Adobe.
A very big test. Oracle, for the record, reported net income of $6.14 billion. That's $2.14 a share.
A huge improvement from a year ago.
Massive. So those numbers will be key for tomorrow's sentiment. But let's zoom out a bit. Let's talk about how the dollar's move just amplified everything.
Okay, yeah, the dollar weakness was huge. The DXY fell 0.55% to 98.67.
Broke right below that 91 level. And that was the perfect cocktail for weakness. The rate cut plus Powell's dovish talk on labor.
And what did that do for global currencies and commodities?
It sent them flying. Commodity currencies surged. The Aussie dollar jumped 0.78%. The Swiss franc had the best G10 performance. When the dollar gets cheaper, assets priced in dollars get a lift.
Which brings us to commodities. Copper, a great barometer for the global economy, surged over 3% to $5.40.
A powerful statement. And it ties directly into that cyclical rotation we were just talking about.
So it's not just the weak dollar?
No, it's also news out of China. They're continuing their proactive fiscal policy for 2026, which boosts demand hopes. Meanwhile, you've got gold extending its record run to 42.28. Natural gas is also on a tear, almost 15% above its 50-day.
All right, now for my favorite part. The classic cross-asset divergence of the day. The coffee conundrum.
Yeah.
Everything is risk-on, dollar is weak, commodities are up, and coffee crashes 5.72%. What gives?
It's a perfect example of micro fundamentals just steamrolling the macro picture. This was purely a supply story.
So it had nothing to do with the Fed?
Nothing. Brazil's CONAB agency raised its 2025 production estimate by 2.4%. That's a huge number. That would be the third largest output on record. When you get a supply shock like that, it just overwhelms everything else. Supply wins.
And that brings us to the ultimate paradox of the day, the crypto conundrum.
Yes.
I mean, you have a perfect macro setup for crypto. Equities are surging, dollar is weak, yields are down, and yet Bitcoin declined. Down 0.79% to 92,231. Why isn't it joining the party?
It's a textbook case of structural issues overwhelming the macro tailwinds. The pressure is coming from inside the crypto market itself.
You mean that idiosyncratic deleveraging we've talked about before?
That's the term. The selling pressure is unique to crypto. It's not related to the Fed or the dollar. It's things like forced liquidations, outflows from certain funds. Those structural unwinds are still happening. Bitcoin is still, 26.73% below its all-time high?
So the relief rally is only helping assets with strong, regulated fundamentals.
That seems to be the clear interpretation for now. Ethereum was a lone bright spot. up a little, but the space is clearly still grappling with its own issues.
Okay, so looking ahead, we mentioned Oracle and Adobe after hours. What else is on the radar?
Well, there's more liquidity support coming. The Fed is going to resume its $40 billion in Treasury bill purchases starting Friday.
Right, the subtle supportive element in the background. Not QE, but still liquidity.
Exactly. And we cannot forget about the delayed November employment report. It's now scheduled for December 16th.
That's the big one.
It's crucial. It will either validate or completely undermine what Powell said about downside risks in the labor market. Until then, the market is kind of flying blind.
So let's wrap with a technical check. The S&P is just 0.49% below its 52-week high. The charts look great, especially with the Russell breakout.
Technically, the path of least resistance is up, but that compressed VIX at 1577 is the single biggest risk.
Because the margin for error is razor thin.
Razor thin. The market is priced for perfection, and any disappointment, especially in that jobs report, could trigger a sharp and immediate correction.
So the takeaway is, the market loved the rate cut. It confirmed this strong cyclical rotation. But low volatility means everyone should probably stay on their toes.
Precisely. It was a busy session, and it gave us a lot more to think about than just a simple 25 basis point cut.
All right, I think that covers all the major action for today. That's the daily consolidation.
As always, remember that this is all for educational purposes. It's not financial advice, so please do your own research before making any decisions.
And if you found this helpful, hit that subscribe button. We're here every single trading day right after the close.
See you next time.